Yes, so TerraVest Industries, symbol TVK on the TSX, is a diversified industrial manufacturing company for multiple industries, including energy, agriculture, mining, transportation, and more. The company has four operating segments: HVAC, compressed gas equipment, processing equipment, and services. I will say, though, they do lean towards that energy sector. TerraVest currently trades at $77.50, a whopping 180% increase over the past year, and that results in a market cap of $1.5 billion. So quite a good year for the stock, to say the least, up 180%. However, zooming out even more at the 5-year chart, the stock has risen 488%. When you see a price rise like this dramatic, or even less than this, but still quite dramatic, you really need to start to question, how do the fundamentals support the price? Even if it's still a good business or has become a good business during that time, that doesn't necessarily mean the fundamentals actually support the price. So looking at the last quarter, fiscal Q2 2024, ending March 31st, the company had strong sales growth of 22% to $250 million from $177 million. However, the sales growth is really just due to the acquisition of LV Energy Service and Highland Tank Holdings over the late last year. So removing the impact of those acquisitions, there was actually a decline in sales for organic sales. So that doesn't count the acquisitions. So that declined by 4%. So no organic growth, and it was just purely acquisition-driven growth. Notably, however, gross margin has increased substantially to about 30% from 25% in the prior year. You do see that shift quarter over quarter because of seasonality. However, this shift is in part due to acquisitions as well, product mix and cost controls, and that's obviously something good to see, a higher gross profit margin. The gross profit margin really was the increasing force between the growth and the bottom line over the past year, as well as the sales growth, of course. The other significant item, however, that really impacted net income was an increase in other gains, which was primarily related to foreign exchange gain and gain on disposal of equipment, both of which are non-recurring. FX management will some years have massive gains or massive losses, especially when they have holdings in other currencies or other countries. So that's not something that they're really doing. So you normally want to watch for that, because occasionally you'll see a massive gain and that props them up into net income, not necessarily in TerraVest's case, but just in general. Increases in foreign exchange or decreases, you really need to take note of that, because that is something that they have absolutely no part in. Unless they're, of course, hedging it, and that's something else you want to look into. But net income income attributed to common shares increased 152% to $22.4 million, and diluted EPS grew to $1.19 from 49 cents. So obviously big increases, but part of that is due to those gains. And for the non-GAAP metrics, TerraVest adjusted EBITDA increased 36% to $44 million, and cash available for distribution increased 29% to $22.6 million. As well, the company does pay a quarterly dividend of about 15 cents, or a yield of 0.8%, which of course has dropped due to the share price over this time. As share price goes up, yield goes down unless there's a correlated or the same dividend payment increase over the same time period. The dividend has increased over the past couple of years from 10 cents, but the share price has just outpaced it. So that's why you end up with that lower yield compared to about 2% a couple of years ago. Moving to the balance sheet, the company does have significant net debt and leases at this time. Debt of $281 million, leases of $100 million, partially offset by some cash, $18 million, resulting in a net debt and lease position of $364 million. However, after the quarter's end, the company has placed $96.5 million in shares at $74.25 a piece, so they're raising money. The placement was initially lower. A lower placement was expected at $65 million, and then was raised to $84 million. Plus, there's a standard option for the underwriters to exercise, which allows them to overallot. In other means, they are able to purchase more shares and then sell them at their own discretion at the same price as the offering. And this option was executed fully, which normally means the market was really looking for these shares at this price. And that is something you want to look into when you do see these issuances. If it's over allotted, under allotted, or wasn't even fully subscribed, that is something that you can tell to gauge the market's acceptance of a capital raise. And in this case, the share price remained above the issuance price. So that normally means the market accepted the raise. But on the other hand, if you saw it drop 20 or 30%, which you do sometimes see with these capital raises, the market isn't accepting of it. And it can just generally be it was priced too low. They don't actually need the capital. Many reasons. But I digress. The additional cash will really be used for debt repayment and general uses. The prior acquisitions, which I was talking about, was 95 million. So this really just offsets that increase in debt. So I wouldn't be surprised if they're just doing it to clean off that debt of their balance sheet as they are levered. Incorporating this pro forma net debt, the net debt to EBITDA ratio is about 1.8 times based on trailing figures. Assuming all else holding equals, you'll likely see a drop over the next quarter as the company laps results that were done prior to these acquisitions. Moving to valuation, the company has a trailing P of 24 times and an adjusted EV to EBITDA of 12 times. Neither of these are exactly cheap valuations given the low, or in this last quarter, negative organic growth. A couple of other factors I'll just quickly highlight to do with the company's underlying operations. The company financials are seasonal, with fiscal Q3 being significantly weaker due to all of its 4 segments being seasonally weaker during the Q3, which is the next quarter, as they are moved up a quarter. Although not purely dependent on Canadian energy market, is still significantly influenced by the sector. For example, the service segment is effectively all, but then if you go to the HVAC, it's less so. But it's very closely tied to the Canadian energy market, but not absolutely like you'd see like with an oil or a gas service company like that. So you will have some cyclicality just connected to Canadian energy. So if you're not wanting to be exposed to that, you obviously don't want to be exposed to TerraVest, but if you do want exposure, it can be obviously an option. As well, if you saw like a 2014 Canadian oil and gas market explosion, TerraVest wouldn't likely implode overnight like some of those companies, but it would be significantly impacted. It could go into negative earnings and so on. But it's not one of those overnight cases where if oil goes down, they disappear. Additionally, I would like to point out, as management has continuously highlighted, the company is still facing labor shortages, which obviously can impact costs and so on, and as well as output if there's significant shortages. Concluding, at this time, TerraVest is just expensive due to the lack of organic growth and is trading at a higher multiple. So just off the valuation and the risk-reward sentiment, it's just too high at this time. The company has improved its balance sheet, which is nice to see, especially with its capital raise at effectively an all-time high price. But the leverage is still a touch high given the cyclical and even seasonal nature at 1.8 times. It's more reasonable than what would be over 2 times without the recent capital raise, but it's still a touch high, but not extremely high. It's not the end of the world either. I would either like to see the valuation or a lower price to have even consider entering a position in the company at this time, assuming the fundamentals stay relatively similar, or of course, seeing better organic growth. Given the risks of the company at this time, you need to see that trade-off become a better trade-off than what it is at this time.
Yeah, no, I think it's a good summary on the business. I think the crux of the argument comes in is, can you get some organic growth? If you had more significant organic growth, maybe you could, those valuations would make a little more sense. It has been built with debt over time. Debt continues to increase. Debt as a percentage of cash flow is something you want to continue to watch. But, I'm not saying this is happening with TerraVest at all, but we've seen that some of these situations built with debt over time. They're built with debt until they can't be built with debt, and then you don't have any organic growth in the business, and then you see a problem. So because you have no organic growth, the only way you can, and if there's some access to debt, either becomes lesser or you're just extended the balance sheet to the point where you can't access debt at reasonable prices, then it becomes a problem. So again, it's something we'd monitor with TerraVest. It is certainly a long-term success story, and the business is admirable in the way they've built it over time. Just love to see a little more organic growth.
Yeah, I quickly, just as a side note too, I quickly pulled out like that 6 million in other cost and calculated like in the last quarter, so like an adjusted EPS basically of like 87 or 88 cents essentially, which I mean still year over year is like 75% growth. So again, rather than, and this is basic, not fully diluted. Mm-hmm. So just FYI, but yeah, if anyone's curious, I just quickly ran that on the calculator while I was listening. Good job,
So
Brett.
what was the growth level?
It was 75% on basic
strong.
EPS. So it went to, about 87.5 cents in the last quarter from 50 cents. Same time last year.
Okay, excellent.